The stock market has been a place of doom for investors of late here in 2022. The S&P 500 is down over 20%. The Nasdaq down over 30%. The Fed continues to hike rates, and they plan to do so through the year 2023. And talks of a recession are becoming less of a thought and more of reality. Where can investors hide during these turbulent times? REITs tend to always be a great place regardless of the economic backdrop. Go ahead and cue up the regular saying, I hear it all the time. REITs do not perform well during times of rising interest rates. Trust me, I really do hear this all the time, but it's really from investors that do not fully understand REITs. There's a reason that REITs have been the best performing class over a number of decades. And if you want to look back at the last time we went through a period of rising interest rates, let's do just that. The last time we saw a hiking cycle like we're currently going through was in June 2004 through Q3 2007, so roughly 3 years. We'll look at the Vanguard Real Estate ETF, stock ticker VNQ, which is a REIT ETF, and it gained nearly 70% during this time, far outpacing that of the S&P 500. So in today's video, we are going to be talking about one REIT position that I will be exiting and two brand new REIT positions that I recently added to my portfolio. About a week and a half ago, it was reported that one of my favorite REITs, STOR Capital, stock ticker STOR, was going to be taken private with GIC and Oak Street investors. These investors agreed to an all-cash deal valued at $14 billion, which equates to a STOR Capital share price of $32.25. On the day of the news, shares shot up 20%. The deal is expected to close in Q1 of 2023. Once this news came out, many investors said, well, why don't I just sell my shares right now? Sell my shares of STOR Capital. But when you dug in and got more information, we actually saw that STOR Capital would be paying their Q3 dividend. That dividend has an ex-dividend date of September 29th, meaning you need to own the stock prior to that dividend date in order to pay out the Q3 dividend. And on top of that, the company increased the dividend 7%. So right now, there is really no reason for me to sell my shares prior to the ex-dividend date. So the next question is going to be, where am I going to distribute these current funds that I have invested in STOR Capital? Well, in today's video, I'm going to be diving into two positions that I added to replace STOR Capital, and both of them happen to be REITs. Hey everyone, Mark here, back for another video where we will be discussing one of our favorite topics, dividends. Dividends, especially growing dividends, can be a great form of passive income. Speaking of passive income, if you are looking for ways to boost your passive income, then come check out my new Discord community, CASHFLOW University. At CASHFLOW University, we have over 10 different passive income topics with over 20 teachers that are in the chat room every single day answering questions of our members. For just $30 per month, you get access to options trading, dividend stocks, real estate content, Turo rentals, social media monetization, and much more. So make sure you check out the link down in the description below and join us over at CASHFLOW University. Okay, with that being said, let's take a look at the two REITs that will be replacing STOR Capital in my portfolio. The first REIT we're going to look at today is Alexandria Real Estate, stock ticker ARE. Alexandria Real Estate has a market cap of $23 billion, and they are considered an office REIT, and that right there might scare off many investors. If you look at other office REITs in the public sector, you'll see that they're down 40, 50, or even 60%, and rightfully so, as many corporations after this pandemic we just went through are taking on more of the work from home environment or the flex work option, thus making less of a demand for office space. However, Alexandria is not your typical office REIT. Alexandria is focused on life science and biotech type properties, making them a very unique type of office REIT, having renters such as Bristol Myers Squibb, Moderna, and Eli Lilly, just to name a few. These are all very strong investment grade companies. In fact, 50% of the company's annual base rent comes from investment grade tenants or publicly traded large cap tenants. 86% of the top 20 tenants are investment grade. As you can see from this chart, the company has strong pricing power, with rental rate increases of 45% seen in Q2, representing the second highest growth rate in the company's history. This has helped fuel a growing dividend for 11 consecutive years, and over those years, the dividend has been increasing at an average annual rate of nearly 7%. Over the past 5 years, we have seen revenues go from $1 billion to $2.4 billion, and cash flows have gone from roughly $400 million to nearly $1.1 billion. All of this helping fuel that growing dividend, which now sits at $1.18 per quarter or $4.72 per year, equating to a dividend yield of 3.3%. As noted earlier, that dividend has consistently been increasing about 7% per year, yet we are seeing a spike in the dividend yield to near a 5-year high. Why is this, you might ask? Well, shares of Alexandria Real Estate are down nearly 40% on the year as the market has sold off, but more importantly, Alexandria shares are getting mixed in with regular office REITs, and that is providing a great opportunity in shares of ARE. In terms of valuation, shares of ARE trade at a forward price to AFFO of 18.9 times, and over the past 5 years, those same shares have traded at an average closer to 30 times. Over the next 2 years, analysts are forecasting AFFO growth of 9% and 11% respectively. This is a very well-run company with a BBB+ rated balance sheet, and a good portion of those STOR capital funds were used to buy shares of Alexandria Real Estate. The second REIT that I bought using those funds from STOR Capital was NetStreet, stock ticker NTST. NetStreet is a small cap REIT, one that you probably have not heard of. The company has a market cap slightly below $1 billion. STOR Capital once started as a small cap REIT, and I see a lot of similarities with NetStreet as I do with not only STOR Capital, but also Realty Income. Once we look at their top 10 tenants and just their tenant mix in general, you will begin to see a lot of those same similarities. And the company is growing at a very strong clip. NetStreet is not only a small cap REIT, but they are also a newly public REIT. They've only been around for 2 years. They went IPO in August of 2020. How's that for timing? The growing portfolio consists of high quality properties that are leased to e-commerce resistant tenants with healthy balance sheets. Here's a look at how the company has continued to grow through acquisitions over the years. They have completed $1.1 billion in investments over the past 2 years, and the portfolio currently consists of 381 properties that are leased out to 75 different tenants within 42 states. Nearly 65% of those tenants are investment grade, which puts them at the upper echelon within the net lease REIT sector. As you can see from the top 10 tenant list, the company works with some high quality and established companies. CVS, Walgreens, Hobby Lobby, 7-Eleven, Dollar General, Advanced Auto Parts, Walmart, Lowe's, Best Buy, and Dollar Tree rounding out the top 10. Here's a look at the top industry exposure for the REIT. Drugstores and pharmacies make up nearly 15%, home improvement nearly 14%, discount retailers 9.3%, grocery at 9.3%, and dollar stores making up roughly 9%. I really like the makeup and the growth that I'm seeing in NetStreet. They have some great tenants and high quality properties that have less of an exposure to e-commerce, something that is very similar to the strategy that Realty Income has. Given the growth that we continue to see and the investment that we continue to see in NetStreet, it is no surprise that they trade at a higher AFFO multiple. In fact, the multiple has come down as NetStreet shares are down 21% on the year. Currently, shares of NTST trade at an AFFO multiple of 16.4. Obviously, the REIT has only been around for 2 years, so we do not have 5-year average stats to compare with. So there you have it, folks. STOR Capital will soon be exiting my portfolio, sadly, but we are getting a nice pop in those shares, and we will be getting a 7% increase in the final dividend paid here in Q3. But I'm also excited for these two great new opportunities. We have Alexandria Real Estate, which is more of a biotech office REIT, much different than a regular office REIT, trading at a massive discount right now, but they are also a high quality, well-run investment grade REIT. And then on the flip side, we're also adding a little bit of growth with a small cap REIT, an up and coming REIT, very similar to how STOR Capital began. Let me know down in the comments section down below if you have any exposure to either of these REITs or if you have ever heard of these REITs. And if you haven't done so yet, please hit that like button down below, as that is huge for the growth of this channel moving forward. Plus, if you're new to investing, Webull is running a special promotion right now where if you sign up for a new account, deposit any amount of money, and they will give you up to 12 free stocks valued up to over $30,000. So definitely take advantage of this limited time promotion with Webull. And that's all I have for you today, folks. And if you haven't done so yet, please again hit that like button, as it is greatly appreciated. And we will see you next time. Take care.